It spooked the market because you look at industrial production, you look at the retail sales number, they both came in a lot less than expected. And as John noted, those numbers have been a little bit weaker or at expectations the past couple of months. So with that, there seems to be a growing consensus in China. It might be a conspiracy consensus in China, but nevertheless, a consensus that they'll stop raising rates this year and maybe even cut rates this year. So that may have started the whole commodities market to begin rolling over overnight. But that's just one of many moving parts going on in the market. That's specific to China.
Larry, John Lind from Thomson Reuters. I actually, this morning in the very early hours here, I actually saw a passage where a comment from a Chinese official suggested the next move in rates in China might be down. Wouldn't that be fairly disastrous? I mean, one of the things that we all worry about is that, you know, if China can overheat to the point where they may have to slam on the brakes. So if they take the eye off the inflation problem and then start to go to the growth promotion again prematurely, doesn't that spell some trouble down the road?
Absolutely, and that's why I mentioned I think it's a small consensus, but you're absolutely correct. I mean, the fact that a researcher came out and said that through the government lines, I mean, he had some type of credence to what he was saying, that, hey, maybe we'll stop raising rates and maybe even cut rates. So yeah, that could be disastrous to our markets. But think about what China's been saying all along, that they want to build 10 cities in the next 15 years as big as New York City. So no doubt that aluminum and copper and everything else fell out of bed today.
And Larry, we should talk about some of the energy plays or some of the energy trading, because in fact a fall was so steep at one point today they temporarily halted trading. What was that like there, and how did that play out for people?
You know, for floor traders, it's not a big deal because we're used to that, believe it or not. Maybe not in gasoline or oil, but certainly in the S&Ps when you have these down moves, that we do have circuit breakers in place. The reason behind all this is that, you know, we need a commodities market where prices can be made fairly and orderly. We can't have a casino. And that's what seems to happen when it's so volatile. It wasn't very hard for traders. It may have been very hard for people off the floor, but on the floor, people are well equipped to deal with that.
Are you getting a sense, or is the market...
John?
Hi, good morning. Is the market getting a sense that perhaps we're in the starting phase of a correction? We're seeing some U.S. dollar strength, some technicals on the U.S. dollar suggesting that could go higher. We're seeing this extreme volatility in the commodity markets over the past week. Is that starting to filter through to the perhaps a view that maybe the equity markets could start to correct as well?
You know, it is, John. And another reason that traders are watching, when QE1 stopped, between QE1 and QE2, when Bernanke finally said he's going to have QE2 in Jackson Hole, the market came in 1,600 points. Now, in his last press conference last week, the chairman said he's definitely not going to have another QE2. So traders are saying, hey, you know what? Once QE1 stopped, the market came in, because this market's been fed just by the Fed, basically. So we're watching that closely, and a lot of traders aren't waiting to June to get out. You're seeing a lot of selling now, and they're taking any news to sell, and they're getting out. Like I said today, the oil really came in, but they sold everything. I mean, it was across the board. I think you're starting to see that. Traders saying, hey, without that Fed, this market might not be able to sustain itself going forward like it did after QE1. So you're seeing an exodus at the door now before June.
Alan, the QE2 is a very important event, I think. Do you think the markets may have been underestimating just the effect of once that sort of air supply has been cut off from the markets? I mean, we've seen ever since Bernanke mentioned at Jackson Hole back in August the possibility of QE2. Asset markets have just taken off. They love the fact of the Fed's quantitative easing. Do you think the markets up till now may have underestimated just the effect of once that air supply is cut off and QE2 ends?
No, I really don't. And you know why I'm saying that? Because there's been no volume. We had volume today, pretty good. It was a little under $1 billion. But basically, this volume we've seen on the upside has been very, very light. It's not indicative of institutions buying. It's just traders buying, really. So this whole QE2 has been fed. It's Fed buying treasuries from the institutions. the institutions coming right back in and buying a little risk here. They're buying the equities because that's where the play is. You're not going to get in money markets or anything else. So they're coming in. But the average person is not buying this market, and we're seeing that in the volume. There has been no volume on the upside. You got a lot of volume on the sell side, but not on the upside. So in general, it's just traders who are playing this very close to the breath. And you're seeing it. Anything goes wrong, they're out right away. That's why the volume picks up on the downside. But on the upside, it's just every day different groups they're taking in. They're going in and out of different groups. But it's not sustainable, and that's been the problem. And that's why we think you're going to see this market come in a little more, because without QE2 or QE3, can this market have legs? A lot of people don't think so.
Larry, let's get your thoughts on all of that then.
Well, my thoughts are the whole thing today revolves around exactly what you and I were speaking about last week, and that is that very crowded bet with people being long euro, long commodities, and short the U.S. dollar. Last Thursday, when Trigger was supposed to be vigilant in his speak and perhaps even raise rates last Thursday, if not June, he didn't have any vigilance in what he said at all last week. And so this is just a basic, massive unwinding of the long euro, long commodity, short dollar trade. And it's going to find equilibrium sooner or later. And for now, that's what we'll see. I think we'll still see commodities coming off a little bit. The S&P and the Dow were only off 1% today. It's still pretty healthy. And as Alan mentioned, it was a pretty lackluster sell-off. That said, there's a lot of the disparity between what the Fed's doing and ECB doing is coming closer together. Neither one of them are going to do anything, so we're going to see this unwinding.
Hi, Larry. John Newton again from Thomson Reuters. You know, after they put on the raised the reserve requirements on silver, there was a delayed reaction, and silver came crashing off last week. It's one of the canaries in the coal mine of all this. Do you think the raising of the energy futures, raising the margin requirements on energy futures, even though it was sloughed off yesterday, do you think that had some effect in the price action today?
It definitely does. It has short-term price effect. Just think of all the ETFs and all the hedge funds out there that have been playing the commodities markets in the last year and a half. When they raise the requirements as much as they have, and I think they should have done it, and I applaud the effort, it's going to cause a massive liquidation so people can get under their haircut. That said, I do believe it's a short term, although I do think commodities in general, in the very short term, will continue to sell off.
Larry, we'll just get one more question in with you and we can go back to Alan because we're about to lose your line. But when you talk about Europe, you're in a sense saying that that's driving things. I know there's two sides of the coin, what's happening in Europe and US with QE2, but you seem to be focusing a lot more on the game, you've called it a game of chutes and ladders, which is kind of the complex situation surrounding Greece and what happens there.
Yeah, there's a lot more, and it's an old game that's been around a long time. Chutes and ladders, and right now in Europe, there's a lot more chutes than there are ladders. I mean, we don't have the solidarity. You have something where the IMF wants to put more money into the system to help Greece survive, and then you have European policymakers who really just want the European banks to survive. So you have this battle going on, and so every move they make is going to be a chute or a ladder, and unfortunately most of them are going to be chutes. Something's got to happen quick. I mean, it's funny, people have said, well, Greece is no Argentina in 2001, and the fact of the matter is those people were correct, but for the wrong reason. I mean, the problems in Greece are 2 times as bad as they were in Argentina, and we wrote off 70% of Argentina's debt. So they have a mess on their hands, and it has to be dealt with sooner than later.
Larry, thank you so much for joining us today.